Hello everyone, and welcome back to the channel where we demystify the complex world of finance. Today, we're diving deep into a fascinating corner of the market, hard to borrow stocks and the potential for short squeezes. We'll be focusing our lens on one specific company that recently caught our attention, NCT or NCT Limited. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's start by getting to know NCT. NCT Limited is an industrial/marine shipping company. Show chart, NCT stock symbol and company name. Through its subsidiaries, it provides maritime shipping services in Hong Kong and internationally, offering time charter and vessel management services worldwide. Interestingly, it's also involved in the processing of pulp, paper, and paperboard products. Currently, NCT has a microcap market valuation of approximately $4.07 million. Its estimated float, that's the number of shares available for public trading, is quite small, standing at around 0.2 million shares. What is cost to borrow and why it matters? So, what does it mean when a stock is hard to borrow? When short sellers want to bet against a stock, they first need to borrow shares, sell them, and then hope to buy them back later at a lower price to return to the lender. The fee they pay to borrow these shares is called the cost to borrow, or CTB. This fee is usually expressed as an annualized percentage. Think of it like renting a car. If everyone wants to rent the same car and there are very few available, the rental price skyrockets. The same principle applies to stocks. When a stock is hard to borrow, it means there's high demand from short sellers to bet against it, but very limited supply of shares available to lend out. This scarcity drives the CTB fee sky high, often well above 100% annually. Why this stock is hard to borrow right now? Now, let's look at why NCT Limited, NCT, popped up on our hard to borrow screener. The annualized cost to borrow for NCT right now is an astonishing 721.5%. Highlight CTB fee on screen. This isn't just a high number, it's seen significant momentum, jumping 78 percentage points over just the last 5 trading days. This indicates rapidly increasing demand to short NCT, coupled with shrinking supply. Speaking of supply, at the time of our analysis, there were only around 10,000 shares currently available to borrow. When you combine this minuscule availability with NCT's tiny estimated float of 0.3 million shares, you can see why the borrowing cost is so extreme. Our internal composite squeeze score, which factors in CTB level, momentum, borrow supply, float size, volume/price momentum, and technical setup, currently gives NCT a score of 48.6. This places it in the mid-range of potential squeeze candidates on our list. Squeeze mechanics explained. So, how does this all tie into a potential short squeeze? Imagine a short seller who borrowed NCT shares at the 721.5% CTB. Every day they hold those shares, they're paying a significant fee. If the stock price starts to rise, two things happen: their short position loses money, and their borrowing costs continue to eat into any potential future profits. At some point, the pressure becomes too great. To limit losses or stop paying the exorbitant borrow fees, short sellers are forced to cover their positions. This means they have to buy back the shares they originally sold. But here's the kicker: if many short sellers try to cover at the same time, it creates a sudden surge in buying demand. With such a limited float for NCT, only 0.3 million shares, even a moderate influx of buy orders to cover could quickly overwhelm the available supply. This forced buying can drive the stock price up even further, creating a feedback loop where more short sellers get squeezed and are forced to buy, accelerating the price increase. Show animation: short sellers buying to cover, price rising rapidly. Dilution risk check. Before getting too excited about squeeze potential, it's crucial to check for dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can offset or completely negate a short squeeze thesis because it provides more shares to the market, easing the borrow supply crunch and potentially lowering the share price. For NCT, we found no recent dilutive SEC filings such as SMINUS-1, SMINUS-3, or 424B in the last 90 days, which is a positive sign for the short squeeze thesis. We also checked for any recent reverse splits, which can sometimes precede or accompany dilution, and found none for NCT in our look-back window. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Now, let's look at NCT recent price and volume action. Today, NCT is down 11.69%. Over the last 5 days, it's down 7.72%, though it has shown some resilience over the last 30 days, up 10.81%. Chart with price action. In terms of volume, today's trading volume for NCT was 111,300 shares. This is significantly lower than its 30-day average volume of 1,682,196 shares, meaning today's relative volume is only 0.16 its average. This low volume, despite the incredibly high CTB, suggests that while the setup for a squeeze exists due to the hard-to-borrow nature, there isn't significant buying or selling pressure actively materializing right now. A high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction in their bearish thesis and are willing to pay a premium to stay short. What you'd ideally want to see for a short squeeze is sustained buying pressure, increasing volume, and a dwindling supply of available shares to borrow, which would force shorts to cover. So, NCT Intercont came in limited presence, an intriguing case with its tiny float, incredibly high and accelerating cost to borrow, and very limited shares available. While the conditions for a potential squeeze are certainly present with no immediate dilution risk, the current low volume suggests it's a situation to monitor closely rather than an active squeeze playing out today. Always remember, the market is complex, and high CTB is just one piece of the puzzle. If you found this breakdown helpful, please smash that like button, subscribe for more in-depth analyses, and let us know in the comments what other stocks you'd like us to cover. Thanks for watching, and we'll see you next time.